Well, good afternoon, everyone. Thank you for joining today for the 1031 Exchange class. My name is Frank Bideau. I am with the Debbie Bannister team at Exchange Resources. And today we're going to be talking about 1031 Exchange and also how to interact with investors, because I think it's very important to understand investors' motivations. So we're going to get started, if it's okay. So a couple of things about Exchange Resources. So you know who we are. We are what we call a qualified intermediary. And a qualified intermediary, basically, it's a company that is here for the purpose of satisfying the code, the IRS code, when it comes to 1031 exchange. And so our company has been in business for 25 years. We are based out of San Diego. We have offices in different areas of the US, and we do business in all 50 states. So if you are wondering if you can do an exchange across state and sell in California and go to Kentucky, for example, then the answer is yes, you can do exchanges across all 50 states. We do all exchange types. There is more than one type. Most people are familiar with a delayed exchange, where you're going to be selling your property first and buying the replacement later. There is also something called a reverse exchange, which is the opposite. You're going to buy first and sell later. You can do a build-to-suit exchange. You can do a hybrid, mixing all of those exchanges together. So we do all of those. And like I said, we've been doing those for 25 years. Now, before we get started with the class, I want to talk about my little disclaimer here. Even though we're going to be talking about a section of the tax code, section 1031, we are not tax advisors. We are not CPAs or attorneys. So it's always important to refer your customers to their tax and legal advisors. It's so easy to cross the line, especially when we talk about exchanges. The next thing you know, people are asking you tax advice. So just keep that in mind. Now, today, what I would like to talk about, we're going to be talking in great details about what is a 1031 exchanges, what the rules of the exchange are, and what you use it for. But I want to talk also about what motivates an investment owners. You know, why would they want to do an exchange? And I think it's important to address that because, you know, many people, even though they kind of have a concept about what an exchange is, some people don't really know how to apply it. You know, what do you do with it? You know, how do you talk to investors about doing an exchange? Why would it benefit them? So we're going to be talking about that first. So I want to have a question for you. And by the way, if you have any questions, feel free to, somebody is saying that barely can hear me. Let me come a little closer here. If you have any questions, feel free to use the chat window, and I will do my best to answer those questions as we move along the program here. So first question is, you know, what motivates investment owners to own real estate, right? So we are all familiar with the first one, which is the income on that property, right? What kind of income that property is going to be returning, the cash flow, the cash on cash return. That's an important factor in owning an investment property. But that's not the only thing, right? So when we talk to investors, the first question is, you know, they're going to say, well, that's great. You know, you want me to sell my property. You want me to go buy something else. You know, what kind of income I'm going to get? You know, my property taxes are going to be, you know, much higher on a new property. The rates, the mortgage rate are so high that it may not make sense for me to, you know, to move forward and sell my property and buy something else. But so most investors are just looking at that first line item, right? The income, the return on their cash, on their property. But they are often forgetting other very important factors that comes into that equation, right? In investment real estate, there are really four ways to make money, right? The first one, of course, is the income. Now let's look at the second one, the appreciation, right? The investment value over time. How is that asset going to appreciate, right? So I'm going to use an example of that gentleman that owns, I was speaking with him the other day in Costa Mesa. He owns a fourplex. It's worth about $2 million now. He bought it for $100,000. And I talked to him about, the benefits of exchanging and maybe getting a better, larger, properties and so forth. And of course, he had some objections. Why would I sell a pretty profitable property and go out and pay more taxes, more property taxes, and get a mortgage and pay a lot of higher rates? And so why would I do that when my cash flow is pretty good? So I told him, you're looking right now just at the cash flow, that income on that property, but there are other things to consider, and the appreciation is another big one. Now, going back to that example, so that gentleman's owned a fourplex Costa Mesa for $2 million. Now, let's assume that that property is going to appreciate at the rate of 5% per year, right? So what is 5% on 2 million? It's 100,000. So year after year, assuming 5% is 30, it's going to get $100,000 more in value, right? That's great. And that's very commendable. But now imagine that if you were to sell that property, take that 2 million, okay, and then go and buy a $4 million property, right? So you sell that $2 million property, you're going to put 2 million down, that's 50%, and then you're going to borrow another 50%, another 2 million. You buy a property that is 4 million. Maybe you go into a sixplex or an eightplex. Now that 5% appreciation, guess what? Can someone do the math very quickly, right? What's 5% on 4 million now? So we are looking at $200,000 in, increase in value. So if that gentleman kept his property at 2 million and get that 5% every year, he's going to appreciate by 100,000. But if he sells that property by a $4 million property at an appreciation rate of 5%, then he's going to make about $200,000 every year. So he's going to double that appreciation rate, over time, with only a $2 million investment, right? So the other 50% is borrowing, even though it's not his money, he's still going to appreciate 5% on that 2 million that he borrowed, right? So that appreciation is so critical, especially when you put a little bit of leverage onto that property. The third aspect is the equity buildup. Who is paying the mortgage when you own an investment property, right? Guess what? The tenants are. So now that gentleman's on a larger property, more income and so forth, the tenants are going to be paying for that $2 million loan that he took, right? So the tenants are going to be paying for the mortgage. And as a result, every year, that gentleman's going to add a little bit more of equity to his bottom line, right? His equity is going to keep building up as the mortgage payments are being made, right? And again, the tenants are doing that. So the equity buildup is the second factor that is important. The fourth one is, what kind of benefits people get when they own investment real estate, right? Well, guess what? Tax benefits, right? Those tax benefits play a major role in owning investment real estate, right? So what kind of write-offs do you get? So as you know, owning investment property, you can depreciate that asset over time, right? Now, remember, you can only depreciate the building, not the land, right? But let's say you own a residential piece of property, and let's say that property is worth 1 million, right? 5 million is attributed to the land, 500,000 to the land, and $500,000 is attributed to the building itself. And the way it works in residential, you would depreciate that building over 27.5 years. So you take that 500,000, the worth of the building, and you're basically going to divide it up in 27.5 years. And whatever that dollar amount for each year is basically the amount of the write-offs that you can take, right? And what does this mean, taking that write-off? Well, it means that it's going to reduce your income and maybe knock you down, a tax bracket or two, depending on where you are. So the more depreciation, the more write-offs that you are going to get. Now, residential depreciates over 27.5 years, commercial 39 years, okay? Now, again, that gentleman that owns that $2 million property in Costa Mesa, he bought that property for 30 years ago. His property is fully depreciated. Doesn't get any more tax benefit, any tax break, right? Even if you bought that property 10 years ago, properties in Orange County have appreciated so much that, that same property, you may have bought it for half the price, 10 years ago. it means that obviously, the size of that depreciable portion of that property is probably smaller, right? So, but if we take that 2 million and reinvest into a 4 million piece of property, assuming that the building portion is like 3 million, now you can take that 3 million, divide that up by 27.5 years, and that's going to give you, like, I think it's like 100,000 or so a year in write-offs, right? So now you can take that 100,000 of your income, and obviously that's going to have a big impact as far as the tax bracket in which you are going to fall into, right? So those tax benefits, after a while, they kind of diminish as longer you own the property, right? So savvy investors are going to typically hold their property for like 7-10 years and take that equity, reinvest in better, larger property so they can get more of those benefits we talk about, maybe better income, better cash return, more appreciation by leveraging that asset, with some kind of financing. The equity build up because now, you have more units, those tenants are making the mortgage so far. The other thing is those tax benefits, right? Because remember, we went from a $2 million property that was fully depreciated, no more tax break, to buying a brand new property for 4 million. You're going to depreciate on a larger amount, and that's going to have a serious impact at the end. So those are, the talking point, the things to address, with those investors, right? And so those are the type of things that, as agent, we need to educate people on. Right? Because a lot of people are missing the point. Why are they owning investment real estate, to begin with, right? To build wealth over time. But it's like managing a stock portfolio, right? You got to adjust and reallocate your assets based on the economy and so forth. That's the same for real estate, right? But if we are able to educate people and help them, take them in that direction, I think it can be a major differentiator, for you as an agent, and really, show your value, if that makes sense. So now that we understand the motivation, let's talk about, the next question. Let's say you have someone who said, okay, great, I want to go and sell my property. Many people, believe it or not, investors do not know about what's a 1031 exchange and what it does. So if you were to sell that property without doing a 1031 exchange, you're basically looking at paying about 35 to 40% in taxes, right? And so it means that if you have a gain, a profit on your property at, let's say, $1 million, then you're gonna be paying about $350,000 to $400,000 in taxes. And those taxes are made of 4 buckets. The first one is what's called the federal capital gains tax. So at the federal level, you're looking at up to 20%. Again, that's going to be based on your tax bracket. That's federal. The state of California, now some states don't have a state tax, so that would not apply, but we're in California, right? So you're looking at up to 14.4%. Now, California does not have a capital gains tax. It's based on your ordinary income. It just went up last year by 1.1%. That's bucket number 2. Bucket number 3 is what's called a depreciation recapture tax. Now, as we already learned, right, you can depreciate that real estate over the years. Those are nice tax break. But if you were to sell that property at one point without an exchange, then the government's going to want a little bit of that money back, right? And that's going to cost the taxpayer about 25% of all of the write-offs, those depreciation that taxpayer took. So if he took 200,000 in write-offs, then it's going to cost him about $50,000 in depreciation recapture tax. The fourth one is what's called a Medicare surtax. That's to fund Medicare. And that's based on your adjusted gross income, and that's 3.8%. So when you have everything up, as you can see, it's pretty substantial. And that's without doing an exchange. Now, that's what we are here, here today, is to maybe talk about a possible solution. So whoever is selling that property doesn't have to pay the taxes right away, and maybe, reinvest the proceeds into a better, larger property. And that solution is called a 1031 tax deferred exchange. An exchange refers to the section of the tax code, section 1031 of the tax code. Now, I want to highlight that an exchange is not a loophole. A lot of politicians out there want to make people believe that it's a loophole, right? Exchanges have been around since 1921, started out to help farmers with land and so forth, and evolved over time. But it's really a great contributor to the economy because it involves many industries. Once you sell a property, you have real estate people involved, agents, you have escrow, title, contractors. It's really stimulate the economy. So exchanges are really adding to the economy. Now, what is an exchange? Like I mentioned, exchanges have been around since 1921, section of the tax code, and it allows an investor to defer the payment of the capital gain taxes as long as that investor is going to reinvest all of the proceeds into another investment property. Now, an exchange is only good for investment real estate, right? It has to be investment, like a rental property, like a vacant piece of land would qualify as well. And also real estate that is used in a trade or a business. For example, let's say you own a gas station, right? Well, you have the gas station, the business, but you also own the land and the infrastructure that would qualify for an exchange. Hotels do 1031 exchange, so many times. Like the doctor who owns his medical practice, the real estate would qualify for an exchange. So to recap, the 1031 exchange is only for investment type real estate or real estate that is used in a trade or a business. Or it could also be a vacant piece of land, right? But only investment real estate. Now, the requirements, the IRS looks at the taxpayer's intent. What is the intent in holding that real estate? Is the intent to hold that property to use it for yourself personally, or is it really to use in a trade, a business, or for investment purposes in the long run, right? So the intent when owning that property is critical. How do you season that intent? Even though the code is not that specific as far as how long you can hold a property to qualify for an exchange, the recommended holding period is 2 years, or at least filing that property on a tax return for 2 tax returns. How do you file an investment property on your tax return? You would use what's called a Schedule E. And a Schedule E, basically, it's a form that it's a schedule that you will, complete and file along with your 1040 when you file your taxes. But you have to report your investment property on that Schedule E to, qualify for the exchange. So those are the main requirements, right? Investment property, held for investment or a trade or a business. You want to make sure that you report that property as investment for at least 2 years on your tax return on the Schedule E. Now, what are the benefits? You're going to see here in a second. The benefits are pretty self-explanatory. Now that I can do an exchange, rather than paying about 35, 40% in taxes, guess what? As long as I reinvest all of my proceeds, I got to keep all of that money. And I can, now I have 100% of my money to go and reinvest into something else. So again, 40%, that 40% in taxes I would have paid without an exchange, I'm going to keep for myself. I'm going to go and reinvest that money for myself, right? So it's like the great benefits of compounding, right? If you keep doing exchanges, that 40% is really going to matter because you can buy more, better real estate with that money. So again, as long as you follow those rules, you keep 100% of your money, you reinvest all of your proceeds, and you can buy yourself a larger piece of property. Rather than giving that 40% to the government that may manage, they may manage your money, better than you do, but I'm sure a lot of people will think they can do better than the government, right? So you keep 100% of that money, you go reinvest that for yourself, and after a while, it starts compounding, right? How many people do we know that started with a single condo? We have so many friends in that situation. 40 years ago, they bought a condo for $25,000, right? And they kept doing 1031 exchanges and so forth. And now they are sitting on millions of dollars worth of real estate because they reinvested those proceeds, those gains, those profits into more and better property and build their wealth over time that way, right? You're going to ask, how many 1031 exchanges can I do in a lifetime? Well, you can do as many exchanges as you want, right? And then you'll be able to defer the payment of the taxes. Now, I want to make sure that we understand that as well, is that the exchange is really about deferring the payment of the taxes, right? So we are not avoiding paying the taxes. At one point, if you were to sell that property without an exchange, then yes, that taxpayer will be subject to the taxes, right? But guess what? You can do exchanges for pretty much ever, never sell your property, or maybe sell one property when you need the cash, and then pay really, little taxes at the end. So that's basically how it works. That's the concept behind, behind the 1031 exchange. If you have any questions, like I said, feel free to use the chat box. I want to make sure that if you have questions about the process and what it does, or some of the rules that I discussed, I'd like to answer them. It's a short question that I definitely like to answer it right away, so you don't keep wondering for 20 minutes what I mean, okay? Now, like I said, we are what we call a qualified intermediary here, right? So what's a qualified intermediary? Our purpose as a company is, of course, to facilitate the exchange and to guide people, taxpayers who are doing exchange through the process. But our main goal is really to hold people's money between the sale and the purchase of the replacement property. Think of us like a 401k rollover, right? If you switch plans, you switch employers, you liquidate your plan, and you're not going to get all of that money, right? That money is going to go straight to the new plan. Kind of the same thing for a 1031 exchange. As you would close escrow on your sale property, escrow, rather than sending the funds to the taxpayer, to the seller, they're going to send the funds to us. And we're going to set up a trust account, a bank account that is designated for that taxpayer, and we're going to hold the funds for that taxpayer until that taxpayer is ready to close on the replacement property. And when they say, okay, I'm ready to close on the replacement, then we're going to wire the funds to the escrow company that is handling the purchase, right? So we kind of come in the middle. You're going to sell the property as you would normally, no change there. It's just at the close, rather than having the seller touch the money is going to go to us. We hold it until that seller, that taxpayer, is ready to close on the replacement property, right? And then we would wire the funds there, and that's the end of the exchange pretty much, right? So that's how it works. That's our main function. We hold the funds so the taxpayer doesn't touch the money between the sale and the purchase. Now, if I ask you what does not qualify, you should know that already, right? Because we know that an exchange is only good for investment properties. So what type of other properties are out there that would not qualify? Well, there you go. The first one is your primary residence. Your primary is used, for your own use. It's not investment. The primary does not qualify. Same for like second homes or vacation homes. There's no tax benefit on those second home, vacation homes, unless maybe you rent that property, a few days a year. But if you don't rent it, if you're just vacant, then it's just a second home that you own. There's no tax break on that. Some people think that dealers and flippers qualify for an exchange because they are investors. Well, guess what? That's not the case. Dealers and flippers do not qualify. The next categories, the next three here are considered personal property, right? Stock and bonds and partnership interest. Sometimes you have seller carrying the loan for the buyers. All of those things do not qualify. That's personal property. That is not real estate. So that's what does not qualify. I hope, again, let me know if you have any questions. Now let's look at the type of 1031 exchange. I mentioned that a little bit earlier. Today we're going to concentrate mainly on the deeded exchange. I'm going to address the reverse mechanics a little bit so you know what it's all about and how to use it. But you have all of those flavors basically, right? So a deeded exchange, you're going to sell your property first, and then with the proceeds, you're going to go and buy the replacement property later. So you sell, then buy. The reverse exchange is the opposite. You're going to buy first, and then later you're going to sell what you have to sell. A build to suit with your proceeds from your sale property, you can not only buy a replacement property, but you can also improve onto it. You can build onto it. You can, fix it up. That's a neat little exchange. A lot of rules to that exchange, a little bit complex, but it could be a good exchange for some people. And for some people who have more complex situation where they have multiple properties to sell, where the timing may not work, exactly perfectly if it was just a regular exchange, then we can mix and match all of those exchanges. So you can do a delayed and a reverse, or a bill to suit that is a reverse exchange, right? So you can mix and match. So we can do and structure those deals in a way that's going to work for that particular taxpayer. Now, I want to mention that now we're going to go over the rules of the exchange. What are the main 1031 exchange rules? All of the rules that I'm going to be discussing here in a minute are the same applied to all of those exchanges. Doesn't matter if you do a delayed or a reverse or a bill to suit, all of those rules do apply to all exchange types. So we're going to review the basics of the exchange. I'm going to review those in details, right? But basically, there are 4 basic rules to remember in a 1031 exchange. The first one is the property has to be like kind, right? Investment for investment. The use is important, not the type of property. Number 2, you have to buy equal or greater in value than the sold property, right? In order to defer 100% of the taxes. Number 3, in order to make everything happen, you have to follow a certain timetable, right? So that timetable, there's no extension. It's what it is, right? You have to make everything happen within that time frame. Rule number 4 is the taxpayer, who is selling has to be the taxpayer who is buying, right? At the end of the day, it's all about the taxpayer, the tax ID number. So if it's an individual selling under a social security number, that individual is going to have to buy the replacement property. If it's a corporation with an EIN number that it's its own entity, then that corporation will be doing the exchange. So the taxpayer has to be the same from sale to purchase. It's why it's very important to really look closely at the prelim when you take a listing, because if you see that it's a partnership or an LLC owning that property, we need to have a conversation to understand really who is behind it, because it's going to affect how we're going to go about the exchange. I have a quick question here about a reverse exchange is cash in hand and purchase without property to exchange. Yeah, you need to have the means to buy that replacement property, right? I mean, you need to have the means. Now, you don't have to buy it cash necessarily. You can finance it as well, right? But you need to have those means. And then once you, sell your property, then you can, get your money back. But I'm going to go and address, I have a couple of slides. I'm going to speak specifically about the reverse exchange. So let's talk about the first rule, the like kind. What is like kind? So as we discussed before, it's investment real estate for investment real estate. And what we mean here is the use. How do you use that real estate? That's what's important. The type of the property does not matter, right? So what I mean by that is that you can exchange a rental condo for a fourplex. You can exchange that fourplex maybe for a ranch land, right? You can exchange a vacant piece of land for a shopping center, right? Because that rental condo, if it's rented, it's investment. The shopping center that you want to buy with your very expensive condo is investment. All of those stores you're leasing out to tenants, that's investment, right? So it meets that requirement, investment for investment. So here again, investment for investment, the use is important, not the type of property. So yes, again, you can go from a condo to a fourplex or a fourplex to, maybe some mini storage or a shopping center. Not a problem. Now let's look at the buy equal to or greater in value than the sold property. Okay, so what do we mean by that? So let's look at how do we figure that out, right? So there is a formula, and the formula is called the replacement value formula, right? So what you have to replace in order to defer 100% of the taxes is the replacement value. It's the sale price minus those non-recurring closing costs, right? And what are those non-recurring costs? That's going to be, like you can see at the bottom, your commissions and your escrow and title fees, transfer taxes, recording fees, exchange fees, any repairs that are agreed between the seller and the buyer. That would classify, fit within that category of non-recurring closing costs. Things like a loan that is paid off, or maybe financing cost paid by the seller, for the benefit of a buyer, or maybe interest or property taxes. All of those do not qualify. Those are not considered non-recurring costs. So if I sell a property for 1.2 and my non-recurring costs are 100,000, my replacement value is 1.1 million. It's my net sale price. So the net sale price is really what you have to replace. Someone asked to show the previous slide. I'm going to be sending you the PowerPoint presentation, so you'll get the whole thing. So you can review that at that time, but you get the whole thing. So that's a replacement value, right? It's the net sale price at the end of the day. Now, the replacement value is the amount to replace to defer 100% of the capital gains tax. Question for you. What if, let's say, I don't replace the whole value? Let's say I only buy for 900,000, right, rather than 1.1. Can I still do an exchange? And the answer is yes. Yes, you can buy for less. If you buy for less, let's say you only buy for 900,000 when you should be buying for 1.1, then you're going to be paying the taxes on 200,000 you're not replacing, right? It's that simple. So that's what we call a partial exchange. Don't exchange the whole thing. And for some people, it works great, right? It's a great, they want to minimize the tax burden overall, but they still want to get a little cash out of the deal, right? No problem. People do that all the time. Now, the other thing to consider is going back to that example, right? So I have a replacement value of 1.1. That's my net sale price. So we know that's what I have to buy equal or greater. But now let's assume that I have a loan on that property. I owe 300,000, right? So I close escrow on that property. I'm going to have now 800,000 in cash after paying off my loan. I only have 800,000 in cash. Is it okay if I go and buy for only 800,000 because it's all I have in cash? Well, the answer is no. You still have to go and buy for that net sale price, that replacement value. So that 800,000, that's going to be your down payment. You know that if you want to defer 100%, you have to go and buy for 1.1. So you're going to have to go and do one of two things on the replacement property. You're going to go and get a new loan for 300,000, or you can bring cash, your own cash to the table, right? But not replacing the loan would result in what we call dead boot, right? It's the boot, basically, it's a taxable event. Same if you take cash out of the exchange, right? Say your replacement value is 1.1. Let's say it's all cash. You want to put 200,000 out in cash. That's cash boot. That 200,000 will be taxable. Same thing for that loan we just paid off, right? If you don't want to replace the loan going into the new property and you don't add more cash to the deal, then you're going to pay tax on that loan that you are not replacing. So here, to wrap up on that slide, the net sale price is what has to be replaced in order to defer 100% of the taxes, right? And the net sale price is your sale price minus your non-recurring closing costs. Any loan that are paid off must be replaced going into the new property, right? It's okay to buy for less, but whatever amount you're not replacing will become taxable, okay? Now, let's look at the exchange table. Now, rule number one, and I cannot stress that enough, right? Rule number one, the exchange must be open before closing escrow on the sale or the replacement property. I probably get 2 or 3 calls every single month, and people calling me up and say, hey, I heard something about a 1031 exchange. I closed the escrow today. I would like to set one up. And I tell them, well, I'm sorry, but you just closed escrow. It's too late. There's no coming back, right? So when I ask them, who was your agent, right? How did you know that, right? Before even selling that property. So when you sell investment property, it's really important to recognize that you have some tax consequences if you don't go the exchange route. And so, always, like I said earlier, to refer your people to their tax, person. So we set up the exchange before closing escrow. Now, the clock is going to start the day you close escrow. So from the day you close escrow on your sale property, you're going to have 6 months or 180 days to close escrow on the replacement property. You have 6 months, 180 days total to complete your exchange. Okay. Now, the first 45 days of the 180 is to identify specifically what that taxpayer is going to buy. And I'm going to go over what it means to identify, right? So you have 180 days total to close escrow on your replacement property. The first 45 days is to identify in writing what you're going to buy. So it's not 45 plus 180, it's 180 total, first 45 to identify, okay? Now, those days are calendar days, okay, not business days. So if day 45 falls on Christmas or on a Sunday, that's the date, that's day 45. Now, those deadlines, again, are not extendable, right? Even if it's not the fault of the buyer, even if, let's say on day 46, you lose the property that you have identified, you cannot close on it because the seller doesn't want to sell to you anymore, right? That's not a good enough reason to basically save your exchange. You lose your exchange. So keep in mind, those dates are firm, no extension whatsoever. The only time you're going to see extensions when you have like a presidentially declared disaster, or if you're in the military, you're on active duty. For example, here actually we have a good example, a sad example. A lot of fires are happening as we speak right now, right, in Orange County and LA County. Well, most likely we'll see some kind of FEMA intervention and some kind of, either from the governor or from the president, a declaration of those zones being the declared disaster area. So I suspect that the IRS, after that, will come up with some ruling allowing for extensions in those areas specifically, right? So we're probably going to see some extension on some part of Orange counties where those fires are happening right now. But that's going to be the only time you're going to see extensions, right? So again, managing that 45 days is critical. And from the day you close, 45 days, that's all you have to identify. We're going to talk about how you can mitigate that and make the most of it. Now, let's talk about a strategy, right, to overcome that 45 days, tough deadline here. So what I would recommend is, before, as you get an offer from someone, from a buyer, is to try to negotiate maybe a longer escrow period, right? So let's say you have a 30-day offer to close escrow. Maybe try to negotiate a 45-day escrow, or maybe some type of extension, right? And then why do you think you would want to have a little more time to close your own escrow, right? Well, it's very simple, because the clock has not started yet. Remember, the clock is going to start the day you close escrow. When you are in escrow on your sale property, the clock hasn't started yet. So that's free time. And that's the time to use to be looking for that replacement property. So when you are in escrow on your own property, you can go out, make some offers on the replacement. You can even open escrow on a replacement property, right? You open escrow, and then when you're in escrow, what do you do? Well, you do your inspections, right? You vet the property, you make sure that's what you're going to buy. So you can do all of that when you're in escrow on your own property, right? You don't want to close escrow on the replacement property until you close on the property you are selling, but you certainly can open escrow on that replacement and really do your due diligence on that property, right? So now, by the time you come to closing day, guess what? Your replacement property is going to be in escrow already, and you don't really need the 45 days anymore, right? Because you've done everything when you were in escrow on your own property. So that's an excellent strategy to mitigate that 45-day window, right? Don't wait until you close escrow. Be proactive, right? Actually, start having those conversations with your sellers, during the listing presentation. You're selling an investment property. Okay, well, looks like you may want to do an exchange. Let's start looking at areas in which you would like to invest in, right? So you start the process early. And then once you get your offer, actually, like I just said, right, then you negotiate a longer escrow period, give you more time. And then by the time you close escrow on your property, then hopefully you have identified the replacement property. So that's a strategy I would recommend to mitigate that problem. Now, there is a form that you're going to use. It's a CAR form. The form, depending if you are representing the seller or the buyer, the seller will be the form SXA, the seller intent to exchange supplement. When you make an offer for an exchange for the replacement property, you're going to use the BXA, the buyer intent to exchange supplement. On that form, that SXA or BXA, you can negotiate the terms of the exchange. On it, you can say, okay, I'm going to sell to you, but I want a 15-day extension on my escrow. I want to make sure I have enough time to find the replacement property. Some people may opt for canceling the whole escrow if they don't find a replacement property. You can negotiate that on that form. Now, I may not necessarily recommend to do that, but that's a possibility, right? So again, as you get an offer, you're going to counterbank that buyer with that SXA or BXA, that buyer or seller intent to exchange supplement. You're going to negotiate the terms of your exchange. It's like a contingent, basically negotiating a contingent offer, right? And then the other thing that you're going to do, you're going to make sure that you include some specific language in that counter offer. We need to put the buyer on notice that the seller is doing an exchange. Again, that's to protect your client, right? And that's the language we insert in your counter offer, right? It's the intent of the seller to do an exchange at no cost to the buyer. And by the way, there is an assignment in contract that's important to let them know as well, because they're going to see the name of the exchange company in the contract as well. So we want to let the buyer know that who the exchange company is, so they don't wonder what that assignment of contract means, right? But again, very important to include that language. So to recap, as you get your offer from your buyer, you're going to send a counter offer with the language in there that says the seller is doing an exchange. And then you're going to counter with that form SXA or BXA to negotiate the terms of the exchange, right? What I don't have here is, how do you disclose that on the MLS, right? On the MLS, you would make a note in the private remark or contingent section that it's the intent of the seller to do an exchange. And that's really all you have to do there on the MLS, right? Disclose that on the MLS, and then on the counter offer, then you'd use a more extensive language to put the buyer on notice. Before we move to the next one, any questions to that point? Okay, so let's talk about what it means to identify a replacement property. What do we mean by that? What do I do, right? So I'm going to show you. But there are basically a couple of ways to identify your replacement property, right? There are two rules. Rule number one is called the 3-property rule, and rule number two, the 200% rule. So let's look at each of those rules. So with the 3-property rule, the taxpayer can identify a maximum of 3 replacement properties, right? So we're going to provide the taxpayer a form, just that form that you can see on your screen. And on it, basically, you have 3 lines calling for 3 property addresses. You're going to write down the address of the property you want to buy. You're going to write down the price of that property. And then you're going to sign and you're going to date that form. That is what we call the identification form. That's how you identify the replacement property. And that form will be due to the exchange company that is handling your exchange by day 45 at midnight, right? So during the first 45 days, you can make any changes you want on that form. You can add, remove properties, go at it, right? But on day 45 at midnight, day 46, whatever is on that form stays and no more changes are possible, right? So if you're not able to buy any of those properties on that list, on that form, then you don't have an exchange and your exchange will fail. You'll pay the taxes. Even if you lose properties, even if you put that property and you're not able to buy those properties on that list, even if it's not your fault, even if on day 46, the seller says, you know what, I'm not selling to you anymore. There's no coming back. Unfortunately, your exchange will fail, okay? So that's the form to use. Now, The 3-property rule, like I said, you can identify up to 3 properties. And then when you add up all of those properties, the total value of those properties, it does not matter, right? So you can add up to 3 properties. You don't have to buy all 3, but you can put up to 3, regardless of the total value of those properties, right? So that's important. Someone asked, is there 3 escrows open? Well, if you buy 3 distinct different properties, one from that, seller here and property A, property B, and C, then yes, you would open 3 different escrows. So as far as us, the exchange company, then we would need to know who those escrow companies are so we can wire the funds from the proceeds to escrow A that is handling property A, and B and C, and so forth. So yes, you would need to open 3 escrows for the 3 properties you are buying. However, not 3 exchanges, the same exchanges, right? But you can split up your proceeds. And actually, that was a good question. Many times people ask, can I sell 1 property and buy multiple properties? Can I buy, 3 properties? Yes, you can sell 1, buy 3. You can sell 3 and buy 1 big one, right? Because at the end of the day, remember, the thing to replace is that net sale price, that replacement value, right? So if my net sale price is 1.1, I know that I have to buy at least for 1.1 in order to defer 100% of the taxes. If I want to split up that 1.1 million proceed into 3 properties, like 350,000 property each, I can do that. I can definitely do that. Now that's a 3-property rule. That rule is the most common rule that people would use the most. Right? It's an easy, pretty straightforward. Now, some people may need to buy more than 3 properties. They may need to buy 5, 6, 10 properties. And that's okay. Technically, you can buy as many properties as you want. Not an issue at all. However, because the IRS likes to make things complicated, you have to follow what's called the 200% rule. Now, you notice that that form is a little bit different, right? You have more lines. Here, we only have up to 6 properties. If you buy 10 properties, then you would add another page, right? But with a 200% rule, you can buy as many properties as you want, right? No problem. The caveat, though, is that when you add up the value of all of those properties together, the total value cannot exceed twice the value of the property you are selling. So I'm going to jump ahead to that example here. If my sell property is 550, I can identify as many properties as I want. I can buy 5, 6, 10, doesn't matter. But the total value of those properties cannot exceed twice the value of what I'm selling. If my sell property is 550, I can only buy up to a value of 1.1, right? If I stay at or below 1.1, no problem, right? But you have to make the math work, right? And in some areas, expensive areas, it can be very easy to go over that 200% rule, to go over twice, the value of what you are selling. So you may say, well, that's not really a problem because I want to buy all of them anyway. So, and that's okay. You could, technically, exceed that threshold. But again, because the IRS likes to make things difficult, then we're going to be looking at a sub rule, which is the 95% exception rule, right? So if you exceed 200% in value, twice the value of, the property you are selling, let's say rather than buying for 1.1, you have identified for 1.2. Now you're going to be obligated to buy 95% of all of the properties you have identified. Right? Now, like I said, you may say, well, that's not a big deal because I want to buy all of those properties, so not a problem. Very good. But let's imagine that on one of the properties you have identified, you cannot close escrow on it for whatever reason. And now, when you add all of those properties together, it only adds up to maybe 80% of that 200%, right? So it's below that 95% threshold. Well, guess what's going to happen? You're going to lose your entire exchange. So either for sure, you're going to close on 95% of all of those properties, And if you're not sure and you fall because you lose one of those properties, you're going to fall below that 95% threshold, you are risking your exchange. You may lose the entire thing, right? So my recommendation is don't go there. You stick to the basics. Either use the three property rule, and if you have to buy more than three, make sure that you stay within the 200%. Don't try to exceed that 200% because now you're getting into very dicey territory, and that there's a lot of risks associated with that. So I would not recommend that. Any questions on that? Good. So now let's talk about the taxpayer. That's rule number 4. We know that the taxpayer who is selling has to be the taxpayer who is buying. Because after all we are known to the tax people is by our tax ID number, right? It's either our social security number, or it could be an EIN number if it's a corporation or an LLC, right? So if I'm selling my investment property under my own name, my social, then I have to buy the replacement under my own name, my own social security number, same taxpayer in both ends, right? Now, if we have a corporation or an LLC that sells a property, an LLC or a corporation that files its own tax return, right? So now that LLC or corporation is the taxpayer, that's the entity. Then that LLC or corporation will have to do the exchange, right? That's the taxpayer doing the exchange. The corporation would sell the property, corporation would buy the replacement property. No problem there. The issue comes in, that's a class on its own. The issue comes in when you have partnerships, right? When you have like LLCs and things like that, you have multiple partners. So let's assume that you have a property that is held into a partnership, right? And there are 3 partners. And that LLC files its own tax return. So the LLC is the taxpayer. That LLC should be doing the exchange. However, those 3 partners, they don't want to buy together going to the replacement property. They want to split. They want to go and do their own things. So that will be okay with proper planning. But if their intent is to split that partnership before or after an exchange, it could be problematic. Because now you're going from the sell side as the LLC being the taxpayer to have 3 different taxpayers, those 3 individuals on the buy side with 3 different tax ID number, maybe their social security number or maybe some kind of, other LLC that they own, whatever. Right, so that's a problem because now you have a disconnect from the selling taxpayer to the buying taxpayer. So in that example, that LLC should be the one doing the exchange, right? And not splitting that partnership on the buy side. That would be a major red flag. Now, remember I said with proper planning, it's doable. So in order to make something like that happen, maybe to dissolve that partnership so the partners could go their own separate ways, you want to give it some time. So either a couple years before selling the property, it's when you would want to drop that property out of that partnership and basically have those 3 partners now own that property as tenants in common, right? And each of those partners as tenants in common would basically report on their own tax return, on their own schedule, their interest, that they own into that property. They do that for a couple of years. They now have a track record as owning that property as 3 different individuals as tenants in common. Now, when they want to sell the property, because they are tenants in common, they could split and go their own separate way. So partner A, as a tenant in common, could sell the property and cash out, and the 2 other partners could do an exchange if they wanted to. And then it goes the same way on the buy side, right? You don't want to split the partnership just after exchanging. You want to give it a couple of years before you drop that property out of the partnership after you buy the replacement. So those situations comes in, in those type of, scenarios. So it's very important to really look at the prelim when you take that listing and to understand how the property is being owned, right? And then so it's going to tell us how to structure that exchange, right? So that's really important to keep in mind. The taxpayer selling is the taxpayer who is buying. It really goes by your tax ID number. Okay. Now, we're doing good time-wise as far as the rules. Now, let's talk about some bonus strategies, but I have to invite you maybe to a 5-minute break, and then we'll reconvene and talk about some more fun stuff and that you can use in your farming, for example. Let's take 5 minutes, and then we'll continue with the presentation. If you want to use that time to ask questions, I'm going to stick around, so please feel free to ask. All right. So let's continue. Put my video back on. Good. All right. So let's talk now about some bonus strategies that you can use in your farming. So number one, let's talk about the reverse exchange. I know you had a couple of questions on the reverse exchange. So a reverse exchange, when would you want to use a reverse exchange? Well, actually, a market like we are in today is a great, it's a great time to use one, basically, because, as you probably know, sometimes inventory is not as great. And by the time you go and make offers on something, you already have, competing offers, and it's really hard to, find that replacement and secure that property, in a timely manner, right? To meet that 45-day window. So that 45 days, can be stressful. And if people don't want to go through that, stress, and they may want to go and prefer to, take their time to find that replacement property, then the reverse exchange makes sense. Now, like I said earlier, you need to have the means to buy that replacement property, right? Because your sale property hasn't sold yet, so you need to be able to buy that replacement first. Now you need to have the cash, or if you don't have the cash, you can finance it as well. You can do either way, right? But so in a low inventory market, really the reverse exchange start making sense. Now, in this type of exchange, it is set up differently than your traditional exchange, right? Because when you think about it, if let's say you were to buy that replacement property first, and then you just purchased it. So now what's going to happen? You're going to own two properties. You're going to own the new property, and you're going to own the property that you want to sell together, right? So now you own those two properties at the same time. And that's kind of a problem because you cannot do an exchange with yourself. You cannot own those two properties at the same time. So we have to set up the exchange in a way that facilitates what the code is requiring, right? So what we're going to do, we're going to set up a holding corporation, and we do all of that, right? So the exchange accommodator would do all of that. We would set up a corporation, a holding entity that's going to be holding either the replacement property or the property that is being sold, depending if there is financing or not on the replacement property. And I'm going to go over those in more details. But basically, from the day you acquire that replacement property, the taxpayer is going to have 6 months, 180 days to close escrow on the sale property. So 6 months from the day you acquire the replacement, you have 6 months to close escrow on the property that you want to sell. The first 45 days of the 180, it's not to identify what you're buying because you already bought it, but it's to identify the property you are selling. Now, if you're selling one property, it's pretty easy. But if you're thinking, I don't know if I'm going to be selling one of 6 properties, then you have only 45 days to make that decision and to identify the properties that you are selling, right? So that's basically how it works. So you have 6 months from the day you acquire the replacement to go and sell the property that you want to sell. Now, at the end of the exchange period, once you sell the property that you want to sell, then the proceeds are going to go back to the taxpayer to reimburse the taxpayer for the money that they advanced to purchase the replacement property, or perhaps to pay off a loan that was taken to acquire the replacement property, right? It goes in reverse. Now, let's look at this in a little bit more details. So you have really 3 steps in the process, right? The first step is what I call parking, Okay, so when closing escrow on the replacement property, the holding corporation that we're going to be setting up for the purpose of the exchange is going to be taking title of either the new property that you are buying or the property that you are selling. Why would we use one or the other, right? So it's really going to depend on how the replacement property is financed. Okay, if the replacement property is financed with cash, so buying cash, then we're going to put that replacement property in that holding corporation. So now the taxpayer, the seller, doesn't own the new property and the one they are selling, right? We got rid of one of the property. If they are paying cash, we're going to park that property into that holding corporation, no problem. Okay. Now, what if there is financing, right? So the problem, if we were to park a property that is financed, it would be a problem not because you cannot hold the property that is financed. The problem would be with the lender, right? Because it's going to be hard to find a lender that is willing to finance a property that is held by that brand new corporation that nobody knows about it, that is set up for the exchange. So no lender is pretty much going to be financing that replacement property that is parked in that holding corporation. So what we're going to do in that case, we're going to have the taxpayer buy the replacement property under their own name. And rather than putting that new property in that holding corporation, we're going to put the property that they want to sell into that holding corporation, right? So they're going to buy the replacement with financing under their name. And so they don't own that new property with the one they are selling before closing on the replacement property. We're going to be dealing out the property that they already own into that holding corporation. So they don't own the new property they just bought and the property they are selling, right? So we're going to be parking one or the other, depending if there is financing or not on the replacement property. The second step is the selling period, right? So from the day we park, either one of those property, the sell or the buy property, goes into that holding corporation. From that day, the taxpayer, the seller, will have 180 days or 6 months to go and sell the property that they have to sell. Like I said earlier, the first 45 days will be to identify the property they want to buy. But they only have 6 months to close escrow on that sell property, right? Now you may ask, what happens if they cannot close escrow on that sell property within 6 months, right? Then worst case scenario, what's going to happen is that they're going to own 2 properties. They don't have to continue with the exchange, right? If they don't want to, that's not a problem, but they're going to own now the new property they bought, and they're still going to own the property they want to sell. So they're going to be owning 2 properties now. The other thing that's going to be out is basically the exchange fee, right? To pay the exchange company to set things up. But technically, they don't have to continue with the exchange. But again, 6 months from the day, that replacement property or the sale property is parked onto that holding corporation. Step number 3 is as you settle the sale of the relinquished property. So as the sale property closes escrow, with the proceeds, what's going to happen, those proceeds are going to go back through the exchange, and I'm simplifying it a little bit, but the proceeds are going to go through the exchange to pay off the buyer, the taxpayer who advanced the money to buy the replacement property, or maybe to reimburse the down payment that the taxpayer put on that property, and also to pay off the lender, if they use financing. So we're going to pay off with the proceeds the lender that financed the replacement property. So the funds from the sale property will be dispersed to pay back the taxpayer who advanced the cash to buy the replacement, and also to pay off the lender that financed the replacement property. So that's how it works at the end, right? Now, there are things to take in consideration, right? Is that some lenders may have some underwriting guidelines, prohibiting reverse exchanges. So before engaging in a reverse exchange, it's going to be very important to have that conversation with the lender to make sure that, their loan is, the investor is okay with that. It's not because a reverse exchange is not legal. It is. It's black and white, in the tax code. That's how you have to set it up. but some lenders, and I'm thinking like Fannie or Freddie, they just don't understand how reverse exchange works. It'll be important to have that conversation with the lender, before doing a reverse. The other thing to consider is that we want to make sure that that loan does not have any prepayment penalties, right? Because remember, as you sell the property, as you sell property, closes escrow, all of the proceeds have to go back into that replacement property, right? Either it's reimbursing the taxpayer, for the cash advanced, or paying off that loan, right? All of that money has to be used, okay? Any money that is not used other than paying back either the taxpayer or the lender will become taxable to the taxpayer, right? So obviously in that case, the lender is going to be paid off earlier as the sale property closes. We want to make sure there's no prepay penalties, okay? And then depending on the states or the counties, in which the exchange happened, you may have some property reassessment, maybe a supplemental property tax bill or things like that. So there's a lot of consideration to keep in mind. But basically, as a nutshell, that's how you do a reverse exchange. So again, it's a great tool when you need more time to acquire the replacement property, or let's say an opportunity comes up and then you have to act on it quickly. You don't have time to sell what you have to sell. And if you have the means for it to buy the replacement, just go and do it. You would set up a reverse exchange. So that's the use really for a reverse exchange. Now let's talk about vacation homes. Remember we said that vacation homes or second homes do not qualify for an exchange, maybe unless you do something with that property, right? So what you have to do basically is to make that vacation home or second home, you have to make it into a rental, right? And the only thing you have to do to make it a rental to qualify for an exchange is at minimum to rent that property at fair market value for at least 14 days per year for 2 years before selling it. So if you rent that property for 14 days in year 1, 40 days in year 2, and you report that property, the income on your tax return on that Schedule E, right? The Schedule E, we don't want to forget about that. And now that property will qualify for an exchange. All you had to do was to rent it for 14 days. So now, 2 years down the road, you could sell that vacation home. You've rented it the minimum number of days that is required. You've reported that property on your tax return. You now can sell it and do an exchange. There is a neat little thing that the IRS will let the taxpayer do as well, is that if you rent it for 14 days, the IRS will let you use that property for you personally for 14 days per year as well. So if you rent it for a minimum of 14 days, you can use it for yourself for 14 days per year as well. Or 10%, you can use it for 10% of the total number of days you are renting the property. If you are renting the property for, let's say, 200 days, 10% is 20 days. You can use the property for yourself for 20 days out of the year, right? So that's pretty neat. But that's could be a pretty neat farm when you think about it. And if you ask your title person to go maybe and find you a list of, second home, maybe you go to the mountains or, beach properties, and ask, for a list of properties that have been owned for, 20 years or plus, where you have a lot of, most likely a lot of appreciations. And to reach out to those people and say, hey, if you were to sell that property, it's just a second home, unless you've rented that property, you don't really have any tax break. So something to consider is that, if you rent it a few days a year, then you may qualify for an exchange. And that could save you a lot of money in taxes, right? So that's a good way to start conversation with, people in that situation. So just keep that in mind. Another question that we have is, can I convert a rental property that I acquired through an exchange into my primary home? The answer is yes, technically. But you need to rent that property for 2 full years. It has to be a rental for 2 years. So technically, 2 years after that, you could move into your property by just moving in. There's no tax consequences by moving in. So you can do that. That's the IRS will let you do that. However, when you bought that property in the first place, your intent had to be made to make that property a rental property, an investment property. You cannot buy that property with the intent of making it or converting it into your primary, 2 years down the road. So when you do an exchange, you buy a replacement property, and you may have in the back of your head, well, I'm going to rent it for 2 years, and then 2 years down the road, I'm going to go and move it, make it my primary. Technically, yes, you could do that. But you really have to be clear, with yourself that when you buy that property, your intent has to make it investment in the long run, right? Now we understand things change for people. Living situation may change. You may have to move into your rental. That things happen. That will be okay. But keep in mind, if that taxpayer ever get audited, it's going to be very important to prove that the intent when that property was purchased was really to make it into a rental, right? I give you an example. I had a situation where a taxpayer bought that rental property using a primary residence home loan, right? So they actually misled the lender, and they told the lender they were going to buy that property to, as their primary. So number one, they got a better rate. But, the loan that they should have taken should have been like an investment, type loan. Well, so they bought the property that way, and then a few years down the road, then the IRS, they got audited, and in looking at their file, the IRS noticed that the property was purchased with a primary home loan, not investment loan. So that was that was a giveaway, right? So obviously here in that case, those people not only misled the lender, but they kind of said they were going to buy that property more as a primary than investment property. So again, here, that intent, when the question was asked, well, your intent, Mr. Taxpayer, was not really to make it investment based on what you've done, with the type of loan you've taken. So, by the way, your exchange is going to be disqualified, right? So making sure that you're buying that replacement property for the right reason. Now, what kind of tax break do we get when we sell a primary home, right? We get what's called the 121 universal exclusion. If I have a primary, if I happen to be married and I own my property for 2 years and I live in it for 2 years, then if I'm single, I can exclude 250,000 in gain. And if I'm married, I can exclude 500,000. So it means that if I bought my property for 300,000 2 years ago, and it's now worth 800,000, and I happen to be married, then that $500,000 in gain, that profit, I don't have to pay taxes on it because of that 121 exclusion. So that's a great deal. And 250 if I'm not, married, if I'm single. Now again, you have to own and live in the property for 2 years. Okay, so that's what you get when you sell your primary home, your primary residence. Now you may ask, that's great, but what happens if my gain is more than 250 or 500,000? What's going to happen? Let's say, like using my example, I bought my property for 300, it's now worth 1 million. So yes, I get my 500,000, but I have still $200,000 that I'm above that 500, so I'm going to be paying taxes on that, right? So that's going to be taxable. So the next strategy I want to share with you is actually something that could be pretty neat to use. Let me pull my slide here. There you go. For people in situation where they bought their primary home a long time ago, they have a huge amount of equity in that property. So let's say you bought your primary for 200,000, 30 years ago. It's a big house, you're married, but the kids are out now. It's a lot of maintenance, and it's expensive to maintain and so forth. So I'm thinking of those baby boomers, right, in that situation with your big primary home, and now they are hesitant to sell because yes, as a married couple they could get 500,000, but what's going to happen to the rest of the gain? They're going to pay a lot of taxes, so they don't do anything, right? They stay put. Now there is a solution for them, which actually could be a great farming strategy for an agent to use that strategy to start conversation with those people in that situation. And then to identify those people, I would talk to your title person and ask for a list of people who have owned their primary for at least 25, 30 years, right? Those people are going to have a ton of equity in it. They're going to be way over that exclusion limit, right? 250 or 500,000. So it's a great niche. It's a great bar, right? Now, what are you going to do with that? So the code, the tax code allows actually for the taxpayer to combine that 121 exclusion and a 1031 exchange together. So yes, you could do both together, right? So, and I'm going to give you an example in a second here, right? But so what that taxpayer would have to do in order to qualify for the exchange, 2 years before selling the property, they would have to move out of the property and rent it for 2 years. So you're converting that property from primary to a rental property, you rent it for 2 years. In 2 years, when you sell that property, now what happened? The last 2 years was a rental property, right? So that would qualify for an exchange. But remember that rule, that 121 exclusion says that you could still claim that exclusion if you lived in a property for at minimum for 2 out of the last 5 years. So from the day you close escrow on that property, the last 2 years was a rental, but the 3 years before that, going back 5 years, was used as your primary. So guess what? You would qualify for that primary, the universal exclusion, right? So now you can get both. By moving out of that property, you rent it 2 years. In 2 years, you sell it. You're going to be able to do an exchange because the last use was a rental. And because going back 5 years, you use that property for at least 2 years as your primary. Now you can get that 250 or 500,000 exclusion, right? So you can get both. 500,000 will go straight in your pocket, and with the balance, you could do an exchange. So if I use that example right here, right? So let's say you have that taxpayer that bought their primary years ago for 300,000, now selling it for 2 million. So their gain is about 1.7, right? As we discussed, the taxpayer is allowed to use the 121 exclusion. They happen to be married, so they can take 500,000. Okay, that's great, but you still have 1.2 in taxable gain that remains, right? Now, using that strategy by combining the 121 exclusion and a 1031 exchange, basically would look like that, right? If I sell my property for 2 million, and again, I moved out, rented it for 2 years, because now I can do an exchange, right? So in 2 years, I would sell it. I would take my 500,000 121 exclusion straight in my pocket, tax-free. And with the 1.5 that is left over, I could do a 1031 exchange. And what does this mean by doing a 1031 exchange on the 1.5? It means that rather than paying the taxes right now, I can defer the payment of those taxes as long as I reinvest the proceeds into a rental property, right? Into an investment property. Now you're going to say, well, some people may not want that, 75, they don't want to get into a new rental property and so forth. But guess what? For some people, it may make a lot of sense rather than paying $500,000 in taxes, right? So that's a good option for some people. It's also a great way to differentiate yourself as an agent in starting that conversation, with people in that situation. Rather than just going and knocking on doors and say, hey, I can sell your property for a great price. It's a good time to sell. That's great, but where do I go from there? And what happened about taxes? Now you can have a different conversation and offering those people actually a solution and engage them in the process a little bit more and really differentiate yourself as an agent. So that's a really powerful strategy to think about. Okay. I have a question here. Is can a taxpayer rent to themselves fair market rent? The answer is no. You cannot rent to yourself. You have to rent to a third party. Next question might be, can I rent to a family member? The answer is yes, but if you rent to a family member, you have to charge fair market rent, and you have to report that income on your tax return, and you need to have a lease agreement in place with that family member. So when it comes to family members and related parties, the rules are very strict. But to answer your question, you cannot rent to yourself. Some people may say, well, I'm going to set up some kind of LLC, and so that LLC owns the property, and I'm going to rent the property from my LLC, right? Well, guess what? In an LLC where you own more than 50% of the stock, then that property, that LLC is considered a related party. And basically you just cannot, rent to yourself. So that's not going to work. Good question though. So now let's talk about working with investors, right? So remember earlier, one of the first slides, we talked about, what kind of conversation to have with an investor, right? We talk about, the income, maybe by getting in a better, more profitable investment property. We talk about the potential appreciation that investor could benefit from, by buying a larger property. We talk about the equity build up, right? The tenants paying for the mortgage, right? We talk about the depreciations, the tax benefits, those write-offs. All of those are important conversations to have, right? But let me bring something to your attention here. I use the word investors, working with investors, right? A lot of people think that investors are those big corporations owning, 100 units, apartment buildings and so forth. Well, guess what? An investor is also someone who owns a condo that is rented, a rental condo. That little single family down the street here that is rented. That person owning that property is an investor, right? So when we talk about investors and working with investor and investment property and working in that realm, we are not talking about just the big boys, right? We are talking about your neighbors down the street who may own a couple little rentals, couple rental condos. And that's a great niche, right? Because those people are a good potential for business, right? And a lot of those people who own those properties don't necessarily understand or know what options are available to them. But as an agent, right, as a realtor, if you are educated in the matter and know that, that your neighbor, that person has owned that condo for 30 years, they are only getting so much rent, it's all paid off. But they may be able to do something better with that equity, reinvest something better. And if you're able to communicate that to that person, then again, that's a great differentiator, as an agent, and most likely you're going to get more business, right? So working with investors and understanding those needs, identifying those needs, again, by putting a title list, right? Property people who have owned their investment property for, more than maybe 10 years, 15 years, you'll find that there's a tremendous amount of potential for business in helping people better those investments, right? Now, the first thing to do will be to, as a realtor, we target your prospects, right? So that's where I was talking about, right? Talking with your title person. And maybe find a list of non-owner occupied properties that could be maybe segregated in couple groups. One could be out-of-state property owned, and others could be properties have been held for between 10 and 25 years. I like the out-of-state because, and we see that in your business, right? A lot of people are leaving California, right? They go and move to Florida or maybe to states where there's no income tax. But in the process, they leave a lot of investment properties behind them here in California. And for those people, it may make sense to bring those property closer to where they live now, right? And we already know that you could do an exchange across states, right? So offering those people maybe to move those California property for properties in a state where they live now could be of great help to them, because now they'll be able to watch their investment closer to where they live now. And then to buy, maybe more properties or something that might be a little more profitable than what's happening here in California, right? So that list of non-owner occupied properties with out-of-state owned properties, that's a great list just for that. And of course, people who have owned their property for at least 10, 25 years because of the amount of equity in those property and because of the diminished, tax break, like those depreciation that, they'll be able to realize or do better by buying a newer property. So those are good prospects. So the first step would be to get together with your title person and to gather those lists and create a list that is manageable, right? where you're going to be able to send some, regular, touch points, mailers and things like that. But also consider using social media, right? You can put a little snippet or things about investment properties or maybe 1031 exchange in your social media, chats, Instagram and so forth, right? So you can use that as well as a medium to create some awareness about that. And then once you have that, next thing would be to put together a script and how do you go about it, right? We talked a little bit about that, but and create some talking points addressing those specific areas that we talked about earlier, right? And that's where we are able to help you with that. We can sit down with you and maybe help you coming up with a campaign and helping you develop those scripts so that can help you, starting to have those conversations with those people. Then once you have those scripts and those things together, then it's going to be to target, marketing accordingly, right? To produce some pieces that are maybe not necessarily high in content, but that could, raise some questions in people's mind, maybe addressing some pain points, right? Worried about, the California rental markets and what's going on as far as legislations. Selling a property and the taxes, the application by selling investment properties and so forth. Things that could generate questions, or maybe people who may be tired of managing their investment properties, and that may be looking for solutions that are more passive, where they don't have to manage the property themselves. All of those things could be attention grabbers and ways to start that conversation with people. So those are kind of the starting point as far as how to go about it, now that we have that information, to gear your business or to go toward that niche. Okay. But again, that, we are here to help you and to help you make that transition if you're not already working with investors or with property owners. That's what we are. This is what we are, here for. Now, those are examples of marketing materials, and I'd be happy to share that, when we are done with the class, not only the PowerPoint presentation, but also some of those marketing materials and sample letters and things that you can use in your own marketing. But the whole idea at the end of the day is to create awareness and to help people realize, the potential that they have with that equity and what they could do with it, right? But you are kind of as agents, you are really the catalyst, of how that's going to happen, right? Online and so forth, there's nothing like a personal relationship where you can really bring value to those people, by just educating those people. So that's my take on that. It looks like we're going to be wrapping up a little bit earlier. Yep, but I'm going to stick around. I would love to take some questions for you and maybe talk about situations that you've been wondering about. So go at it, please. If you have any questions, be happy to assist with that. I have a good question here from Jeff again. After death and the heirs want to sell, what amount do their heirs pay taxes? So if the property is held correctly, for example, if you hold a property in a trust, right, and your beneficiary inherit the property, so those beneficiaries would get what's called a step up in basis, right? Meaning that the value of the property at the time of death would be reassessed as what the value is at the time of death, right? So if, let's say, you bought a property years ago for 100,000, that property is now worth 1 million as of the date of your passing. So your heirs would inherit that property at the new basis, that 1 million, the new value, right? So if your heirs were to sell that property the next day for 1 million, then at the end of the day, they would pay no taxes. All of the gains was accumulated during your life would be basically wiped out. Now, if that heir, rather than selling the property right away, was to hold the property for a longer period of time, say they want to hold the property for another 5 years, then at that point, the gain would be calculated from the new basis, at the time of your passing to 5 years down the road. So that gain for that period, that what they would be taxed on. My pleasure. On the step up in basis, it's what a lot of people do. They just keep exchanging, and then all of their assets is what are in that trust, and then when they pass, then all of those properties, those assets, goes to their kids, and with that step up in basis, and that's a great deal because that's the only way to beat the system. Basically, it's to pass. That's how you beat the system.